Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Mike McGlone, macro strategist at Bloomberg Intelligence. Welcome back, Mike.
Welcome back, Ivan. It's good timing. We'll see what happens with the Fed.
Yeah, it's an absolute pleasure having you back. And of course, seeing what the Fed's gonna do is pretty interesting. That's what everybody has their eye on. They keep raising rates. There's so much debt and problems mounted up in the system. How can the Fed continue to raise interest rates without breaking something? And how will this affect gold and silver?
I think it's going to accelerate the existing trend of gold outperforming virtually all assets, with the exception so far on a 12-month basis. Gold is up about 8%, silver's up about 13%, and platinum's up about 13%. So those typically are not the long-term trends. Typically, gold outperforms platinum and silver, most notably in U.S. recessions. I think that's going to accelerate, but for now, we're seeing the other precious metals do okay, with the notable exception of palladium, which I fully expect to continue to fall to the wayside because they're more industrial based. But the key thing right now with the Fed is we're potentially going to, we're on the third, the day of the Fed meeting, and probably going to publish this on Friday or so, whenever,
Mhm.
is they're going to, hike 25. And my base case is that's the last hike. The Fed, that's not much, a lot very profound, because Fed fund futures for already priced for dropping another 50 basis points, if not actually almost 60 basis points by the end of the year.
Right.
But I think what's going to happen from this is that recession is going to kick in big time. Now, our chief economist, Anna Wong, says it's going to start around July, now that she's moved that forward with the credit crisis. July is also a unique month because we're going to be hitting the see how we happen with this debt crisis, which will be resolved. But it's also very significant because it's when we're going to get inflation data
Mhm.
that's going to show significant signs of deflation from the high beta measure. The highest beta measure of inflation is PPI, the Producer Price Index. And it's going to measure, that's going to be on July 13th, it's going to print for June, and it's going to measure from June 2022, the June 2023, and June 2022, the Bloomberg Commodity Index peaked, and it's down about a third since then. So by the time we
Right.
get to that measure, it's going to show clear year-over-year deflation in PPI. So the key metric is PPI's a measure. Inflations are markets, and they're leading and they're collapsing. As we speak today, crude oil is at $68 a barrel. This time last year, people are calling for 120. But the key thing, remember, is PPI is basically about a 2 beta to CPI, and CPI is very sticky because of things like owner's equivalent rent, and all that stuff is starting to turn over and tilt down harder. And in many cases, PPI is dropping at the fastest pace in history, harder than it did during the great financial crisis, and the Fed is still tightening. So here is, to me, the beginnings of my base case for a severe economic reset, and it's not even getting started. The Fed is still
Wow.
tightening.
Well, so you said a severe economic reset. What happens to the US dollar? What happens to even, let's start with gold then. What do you see a price target for gold within the next year or two?
Yeah, so time and price targets together are something strategists learn the lesson with doing. Now we can do that when you structure positions, but I fully expect gold is like playing with like a 2 bid right now. I look at it from a trading standpoint; it's just going to pop to a 3 bid, go towards $3,000 an ounce.
Wow.
I think 2000's getting to the point where it's never going to look back, um, particularly as the market anticipates an ease, and the key trigger will be when the U.S. stock market kind of rolls over. I kind of should say if, but I think it's more going to be of a when. And then I don't think there's anything that stops gold from continuing to outperform. Here's a good example. It's up 8% this year. Copper's down 10%. WTI crude's down 30%. Natural gas is down 70%. So it's
Right.
commodity deflation, which is showing the deflationary trends to look forward to, and it's fueling gold inflation. So how it happens, when it happens, is more the difficult part. Used to have hair trying to figure those things out. But to me, the key inflection will be is when we've had this most historic period of the last decade of the U.S. stock market outperforming the world ever. I mean, versus if you take S&P 500 versus MSCI ex-US. My colleague Gina Martin Adams pointed this out to me. She's our chief equity strategist. And at the same time that happened, when that's happened, there's no reason to buy gold. That's all turning backwards now.
Right.
Stock market got the most expensive ever versus GDP, versus the rest of the world, versus the US housing, versus sales. And it's got a good reason to give that up, which means gold is the number one, I think, top alt. Now, that's a current trajectory. The key thing is what stops that. So the Fed's going to probably stop tightening. And the key problem is if the stock market keeps going up, it's going to trigger them to do more tightening. That's just where we are right
Absolutely.
now, and and that's why it's a lose-lose for risk assets. And I think it's part of that, just close to that optionality trade where everything's priced for a soft landing, and that means your risk reward is to tilt the other way because that's where you're going to get the most vig for a position, I think.
Absolutely. Mike, I read an article recently. It said a $1 trillion platinum coin would save the US economic catastrophe. Why can't they rationally discuss budget cuts to get things under control instead of just bring up a $1 trillion platinum coin to solve everything?
Well, they is not, I think, the parties who would actually be able to make the decision to do that. To me, that's something I don't really like to go to because a government doing that is maybe something more third worldish.
Right.
I think it's fun to talk about and knock down the potential iterations. But the key point is the government, our leaders will always come to the right decision conclusion, as Churchill said, after we exhaust all available options. But here's one key trigger to force a a, a, um, a budget agreement, and that is stock market going down. That happened in 2011. We had, downgraded the debt. There was a big swoon and forced people to the bargaining table, and it could happen again. That's an almost foregone conclusion that's what could stop Fed tightening. Number one force to stop Fed tightening quickly is the stock market going down with high velocity. It's not profound. It's just the rules of history and markets.
Right.
But this budget stalemate, if the market starts, if you read in the New York Post and Washington Post, New York Times, that stock markets drop 5 to 10% or so because of a budget impasse, then they'll come to conclusion, right? So see, part of my whole scenario, everything to me is bad for risk assets, most notably the stock market. And a key trigger might be Bitcoin and cryptos. They're already starting to roll over. So how that works out, I don't know. I just kind of getting sick of those words, the oxymoron of US
Right.
and default. It's just not even worth it to say such things because it is our treasuries are considered the world's riskless securities. Let's prove that.
Hmm. Absolutely. And I have to ask you, Mike, we are Wall Street Silver, so we need to know your thoughts on silver. Silver is about 25 per ounce right now. What do you think is driving the price of silver?
At the moment, there's good reason for it to go up, but let's remember all assets that went down last year, virtually all assets went down last year, are up this year.
Right.
And silver is just, leveraged gold. When gold goes up 1%, silver usually goes up 1.6%. But I'm not bullish silver, particularly versus gold, and particularly as I see this um, expectation for soft landing in the US probably tilting more towards a severe deflationary recession. And at the time, I just sent to editors my just an outlook for gold versus silver, platinum, palladium, and commodities. So by the time this publishes, that will be out on the tape.
Nice.
And I see the key point I like to make over silver is silver almost always outperforms gold when US and global economies are expanding and Fed's tightening, and we have a good organic demand pull. And it does have some good attributes for it for electrification. But over time, silver has been underperforming gold since Sir Isaac Newton was, the royal head of the Royal Mint in the UK in 1717. I mean, this is like, I think the per ounce price back then was probably 16 ounces
Hmm.
of silver per gold. Now it's 80. And so I fully expect I like to talk about the gold silver ratio. Silver, I don't know exactly where it's going to go, but way underperform gold as we tilt towards this recession is not a profound statement. It's usually what happens. The
Right.
gold silver ratio is about 80. The peak is 124. The high during the crisis was 80. So I think we're forming a foundation to get to the next high. That's usually what happens in a recession where gold's going to outperform virtually every asset, most notably silver, platinum, palladium, and commodities, and the stock market. And silver is just one of those things that pushed by the bucket. So here's the problem I have with silver. It's more like to be trade. It's industrial, more likely to trade like copper. It's not the global base currency. Central banks aren't buying silver; they're buying gold. And I think as we tilt towards this recession, it's going to have an issue like copper. And I fully expect copper, which has been hovering around $4 a pound, it's offered now. It's going to head towards $3. So I'm looking at it was trading 4 bid to go back down to towards a 3 offer in copper, which is highly correlated to silver.
So where do you see the Fed now going as they continue to raise rates? You've seen the bond market already blow up. What's next to blow up? What are you watching for?
Well, first of all, let's look at the U.S. government 2-year note. At the moment, it's 3.93, and Fed funds today are going to go to 5.25. So the
Mhm.
market's already telling you the Fed's going to be easing soon. I look at my WIRP function in a terminal, and it shows peaking here at 5. It's going to be a base rate around 5, a target upward bound of 5.25. 5.25%, and then dropping by December to 3.37%. So the Fed's going to start easing, but that's only going to happen, according to the markets, if the market makes them. So their inflation metrics are very sticky, according to our colleague Anna Wong. Personal consumption, expenditure, employment cost index, very sticky numbers that will stay sticky, which is what they watch. But I like to watch the high beta in markets, which are tilting towards severe deflation. So I think they're going to stop. And to really trigger a quicker than expected ease, you need pretty severe asset deflation, meaning the stock market, because I don't think they're ever going to ease with the ease they have in the past, based on the lessons of easing too much during COVID and creating the inflation, which they were part of. So this is, to me, what's happening. We're in the middle of the biggest liquidity dump in history, on the back of the biggest liquidity pump in history. Any measure of markets over time in history shows that when assets pump on liquidity and then dump when liquidity contracts, you expect very severe busts.
Right.
And we're in the early days of a bust. The Fed hasn't figured out. So by the time we speak next year at this time, I fully expect we're going to be in a severe deflationary, depressionary environment, unemployment going up, deflation continuing to trickle. Its current trend is PPI is dropping at the fastest rate in history,
Right.
and plenty of pressure for the Fed to ease, but they'll never ease with the ease they have, and they're going to start to be in pressure like we've had in the past. There'll be death threats, unemployment will be ticking up. There'll be threats to um, to ban the Fed. I mean, we've had these throughout the history of mankind, and certainly
Right.
the last good example with death threats for the Fed was with Paul Volcker. Now he's a hero.
No.
And Mr. Powell keeps invoking that name. Well, there was a lot of pain that Mr. Volcker had to go through. And I think that pain that Mr. Powell mentioned is going to be pretty severe by the time we get to next year. And key question I ask is what stops it? The Fed is still tightening, most aggressive pace ever. Here's a key thing I'll leave you with. Fed funds rate at 5.25 is gone up the most in history. If you look at a log normal scale, obviously came
Mhm.
from zero. And PPI, producer price index, is at 3.2%. So Fed funds are 2% above PPI. And PPI is an embodied motion that's dropping at the fastest pace in 75 years.
Yeah. And it's I bet it's only going to get worse, like what you were saying
Yeah.
for next year. So it'll be interesting to watch. Well, thank you so much, Mike, for coming down to Wall Street Silver, and hopefully we can have you back on in the next 2, 3 months.
Thank you. Looking forward to it, and looking forward to see how things pan out in the next 2, 3 months.
Yeah, of course we are too. Awesome. Talk to you soon, Mike.